An accountant in Iowa formed an S-Corporation and paid himself a W-2 salary of $24,000 while taking $200,000 in distributions. He saved approximately $26,000 in FICA taxes. The IRS audited him, reclassified the distributions as wages, assessed $29,500 in back payroll taxes and penalties, and won in federal court. His name is David E. Watson. The case was decided in 2012. The IRS still cites it, and the structure he used is still being copied by S-Corp owners who do not know how it ended. The S-Corporation tax strategy is legitimate and widely used. When you elect S-Corp status, business profit can be paid out in two ways: as W-2 wages, which are subject to payroll taxes, the 15.3% FICA split between employer and employee, or as distributions, which pass through to your personal return as ordinary income but are not subject to FICA. The strategy is to pay yourself a W-2 salary and take remaining profit as distributions, saving FICA on everything above the salary. The savings are genuine and scale with income. On $200,000 of S-Corp profit, if you pay yourself an $80,000 salary and take $120,000 as a distribution, you pay FICA only on $80,000. FICA on $80,000 is $12,240 employee side plus $12,240 employer side, totaling $24,480. If you paid the full $200,000 as a salary, your FICA would be $30,600 each side, but FICA only applies to the first $168,600 in wages for the Social Security portion in 2024, so the actual comparison is more nuanced. The Medicare portion, 2.9%, applies to all wages with no cap. The requirement for reasonable compensation comes from IRS Revenue Ruling 7444 and subsequent guidance, which establishes that S-Corp shareholders who provide services to the corporation must receive a wage commensurate with the services they provide. The IRS defines reasonable compensation as what a third party would pay for the same services in an arm's-length transaction. This is deliberately flexible, but it is not unlimited. The question the IRS asks is, if you had to hire someone else to do what you do, what would you pay them? The IRS uses several benchmarks to evaluate reasonable compensation. Industry wage surveys are the primary reference. The Bureau of Labor Statistics Occupational Employment Statistics database publishes median wages by occupation. Courts have also examined the ratio of salary to distributions as a factor. In Watson's case, a salary of $24,000 represented less than 11% of his distributions in some years. Courts have generally found that ratios where the salary is a small fraction of total compensation suggest the salary was set by tax considerations rather than reasonable wage norms. There is no IRS published safe harbor percentage or formula. However, the tax court and other courts have identified relevant factors: the duties and responsibilities of the shareholder employee, time and effort devoted to the business, compensation paid to non-shareholder employees for comparable work, the company's dividend history, the prevailing compensation for similar services in comparable businesses, and the company's ability to pay based on its financial condition. A CP, Conducting a reasonable compensation analysis will typically reference BLS data and an industry-specific salary survey such as RC reports or value scope. The practical approach for most S-Corp owners is to benchmark your salary against what a replacement hire would cost for your specific role in your specific industry and geography. A web developer in Austin, Texas, running a solo S-Corp should benchmark against Austin market rates for full-stack developers, not national medians. A dentist running a dental practice should benchmark against associate dentist compensation in her area. The salary should be defensible on its face as market rate compensation, not optimized purely for minimum FICA exposure. The IRS has increased S-Corp examination activity. A 2019 Treasury Inspector General report found that approximately 266,000 S-Corp with total positive income paid no wages to shareholder employees, representing a potential tax gap of $3.3 billion. The IRS responded with targeted examination programs. An S-Corp showing distributions but no W-2 wages is a significant audit flag. An S-Corp showing a W-2 salary that represents less than 20 to 30% of total distributions is a softer flag but still attracts scrutiny in higher income brackets. If you are reassessed and distributions are reclassified as wages, the consequences compound. You owe both the employer and employee share of FICA, 15.3%, on the reclassified amount. You owe failure to deposit penalties for not withholding when payments were made. You owe interest on unpaid payroll taxes from the original payment dates. You may owe accuracy-related penalties of 20% on the additional tax, and the state may follow the federal adjustment with its own assessment. Watson's total bill was considerably more than the FICA he was trying to avoid. Set your S-Corp salary at a number you can defend as market rate compensation for the services you personally provide to the corporation. Run an industry benchmark comparison and keep that documentation in your files. Pay yourself through an actual payroll system with proper withholding, not a manual payment at year-end. If your S-Corp income is $150,000 and you are paying yourself $18,000, adjust the salary before the IRS adjusts it for you. The FICA savings on an S-Corp are real and worth capturing. Capturing them with a defensible salary is the only way they stay captured. Setting a defensible salary is the audit-safe half. The deeper question is whether your distribution method is even structured correctly for how you actually pay yourself. If this helped, paying yourself as an owner's draw versus salary, and what the IRS watches goes further. It is on this channel.